Mortgage insurance gets a really bad rap, but what if I told you it could be the difference between owning a home and not at all? Well, that's exactly what we're going to discuss in today's video. We're going to talk about what mortgage insurance is, how it works. More specifically on an FHA loan, we're also going to be talking about how to calculate it, the difference between upfront mortgage insurance and the monthly mortgage insurance, and ultimately why mortgage insurance isn't really a bad thing at all. I want to start today's video by actually explaining what mortgage insurance is, because a lot of people don't truly understand it. They believe that mortgage insurance is there to protect them, kind of like their homeowner's insurance, when in all reality, it's not that at all. It's there to protect the lender. Because FHA loans allow you to put a minimal down payment, as little as 3.5% down with a 580 credit score, they will actually allow you to go as low as a 500 credit score and put 10% down. But mortgage insurance is required on any loan program, regardless of whether it's FHA or conventional, when you put less than 20% down. Now, there's this belief out there that somehow you can avoid the mortgage insurance because there are mortgage brokers out there that when you're having this conversation and you're getting pre-approved, they tell you, hey, yes, you're putting less than 20% down, but I have this special loan program that allows you to avoid paying mortgage insurance. Understand, you're paying that mortgage insurance in one way or another. And when they say that, you're likely paying it by taking a higher interest rate on that loan than you otherwise would have if you had put 20% down. So now that we got all of that out of the way, let's explain what mortgage insurance is. It is there to protect the lender in case you, as a borrower, default on that loan because you're putting less than 20% down. And in the case of FHA, you're typically putting somewhere around 3.5% down for most borrowers out there. So from the lender's point of view, you're at a higher risk of default than a borrower that's putting 20% down. And because of that, the lender has you pay this mortgage insurance. Now understand, with FHA loans, mortgage insurance is required on every single loan. There's absolutely no way around it. Regardless of how much you put down, regardless of your credit score, you're going to have mortgage insurance. In fact, one nice thing about FHA loans is that the mortgage insurance, the upfront mortgage insurance premium, as well as the monthly mortgage insurance, which we're going to talk about both of those here in just a minute, are exactly the same for every single borrower out there, regardless of your credit score, if you're putting 3.5% down. And that's where I want to transition and talk about the difference between upfront mortgage insurance and monthly mortgage insurance. But before I do that, I'd like to take a minute and ask a favor. If you find any value in my videos at all, do me a favor and hit that thumbs up. And if you want to stay updated on everything FHA, mortgage, and real estate related, do me a favor and hit that subscribe button. Now, before I dive into the difference between upfront and monthly mortgage insurance, I want to take a minute here and talk about why people say mortgage insurance is a bad thing, right? You often hear people on the internet say, do not buy a house if you have to get mortgage insurance. Mortgage insurance is a ripoff, so on and so forth. But understand, it's the cost of doing business. Unless you have 20% down to put on a house in order to purchase it, you're likely going to have mortgage insurance on that loan. And if you don't have mortgage insurance on that loan, you're going to be paying a higher interest rate that essentially has that mortgage insurance built into it, so that either way, you're covering that premium on a monthly basis. So while ideally you don't have mortgage insurance and you have 20% down, that's not the reality for most home buyers out there. And that's why I want to stress that mortgage insurance is not a bad thing, because it's allowing you to buy a home, whereas otherwise you would not be able to do that. So instead, just look at it as an opportunity cost in order to be able to get you into a home. And over time, as you pay the mortgage balance down on that home and your property value goes up, assuming your income and employment and everything else stays the same, you should be in a position to refinance out of that FHA loan into a conventional loan. Whereas if you just waited to save 20% down so that you could buy your first home, saying using a conventional loan so that you didn't have that mortgage insurance, well, not only is it going to be difficult and take more time to do it, but at the same time, you're missing out on that opportunity to gain appreciation and put money into that forced savings account by paying down the principal balance. In fact, the longer you wait, the longer you are paying someone else's mortgage on their property if you're renting. Now, I'm not saying this to scare you into buying a home. I just like to be real in these videos and debunk the whole idea that mortgage insurance is bad. But with that, I want to get back to the difference between upfront mortgage insurance and monthly mortgage insurance, because a lot of people believe it's the same thing, when in fact, it's two different things when it comes to an FHA loan. Now, the nice thing about conventional financing, for example, is that if you put less than 20% down, you only have that monthly mortgage insurance payment. Whereas when you buy with FHA, not only do you have the monthly mortgage insurance payment, you also have an upfront mortgage insurance premium as well that's tacked onto your loan balance. And we're going to talk about how to calculate those here in a minute, but you can pay that premium separately if you want and not finance it into your loan amount. You can pay that fee separately as part of your closing costs, but most people finance it into the loan because the lender allows it, and it ultimately allows you to come up with less money out of pocket when buying that home. But at the same time, understand, with FHA, you're putting 3.5% down, and that upfront mortgage insurance premium that we're talking about is 1.75% of the loan amount. So while you're putting 3.5% down, you're essentially losing about half of that down payment because of that upfront mortgage insurance premium being added back to the loan amount. But let's take a minute here and explain what we're talking about. So say, for example, we're buying a $500,000 home using an FHA loan. Well, FHA allows a minimal down payment of 3.5%, which means our down payment on this home would be $17,500 because that's 3.5% of $500,000. So that would give us a loan amount of $482,500. And typically this would be your loan amount. But with FHA, because of that upfront mortgage insurance premium, you're going to multiply that $482,500 by 1.75%, which in this case, $8,443.75. Now we take that amount and we add it back to that loan amount of $482,500 to get our base loan amount, because everything is based off that base loan amount when it comes to your monthly payment, when it comes to that monthly mortgage insurance, which we're going to talk about here in just a minute. So if we take that $482,500 and we add that $8,443.75, we get a base loan amount of $490,943.75. So now when we're calculating our monthly mortgage payment and trying to get an idea of how much that's going to be, that's the number that we're using. And I know a lot of people watching videos like this will go and do the calculations and try to figure it out and try to figure out what their interest rate is. Now, while you're doing that, I would just like to offer a friendly reminder. This video is for novelty purposes. It's not for you to go out and figure out your loan amount, figure out your interest rate, and determine whether or not you qualify for an FHA loan. I'm here just educating you and guiding you through the process so that you have the information necessary. Now, if you're interested in going through the pre-approval process, you want to see what your loan amount is, what your interest rate is, where you stand in the process, instead find a knowledgeable mortgage professional that can guide you through that process. Now, don't go searching online, find a referral. If you don't have a referral, I created a link in the description of this video that will take you to somebody I personally know, like, and trust that can guide you through that process and not only answer your questions about mortgage insurance, but help you determine whether or not you qualify to buy a home. So if that interests you at all, do me a favor and check that link below. So now that we have our base loan amount of $490,943, we need to determine how much our monthly mortgage insurance is, because that's also one piece of the puzzle, right? We have the principal and interest payment, which is based off our interest rate. We have our property taxes, which is based off whatever the average rate is in your county. In addition to that, we have homeowners insurance, which covers things like fire and theft and all of those different things on the property. But in addition to that, we have mortgage insurance. Because you're putting less than 20% down, you're going to have that mortgage insurance, which with an FHA loan is 0.55%. So what we're going to do is we're going to take that $490,943 and we're going to multiply it by 0.0055, which is going to give us $2,700, which is actually the annual premium. So in order to determine how much it is per month, we take that $2,700 and we divide it by 12, which breaks down to $225, which is exactly how much the mortgage insurance would be on an FHA loan at $500,000 using that 0.55 calculation. Now you can use those same numbers on any loan amount and determine not only your base loan amount, but how much the mortgage insurance premium is. But if you're wondering what your interest rate's going to be, what your property taxes are going to be because you're trying to calculate your total monthly payment, well, there's something you need to understand. Those numbers, at least the interest rate, changes every single day. In fact, it changes a couple of times a day. So instead of just searching online trying to figure out what the interest rate is, make sure you talk to one of those brokers in the link that I mentioned in the description below. Now, one of the questions that often comes up when I start talking about mortgage insurance is people say, well, what if I put 20% down? Or what if I do this or that with an FHA loan? How can I get around the mortgage insurance? And as I mentioned earlier in the video, you cannot get around mortgage insurance when it comes to an FHA loan. But there is one caveat that you need to understand. If you get an FHA loan and you put 10% down on that loan from the start when you initially get the loan, well, then you'll have mortgage insurance on that loan, but it will only be on there for the first 11 years. And after the 11th year, that monthly mortgage insurance will actually fall off that loan. But that only happens if you put at least 10% down when you're originally getting that loan. But even with that, you're not able to avoid that upfront mortgage insurance premium that I mentioned earlier. So regardless of how much you put down, you're still going to have the upfront, but the monthly is going to stay on that loan regardless of how much equity you get in the property, regardless of how long you have that loan. If you put less than 10% down, but more than 10% down, it will fall off after year 11. Now, this is where a lot of people say, I don't want an FHA loan because it has the mortgage insurance for the life of the loan. I don't want to get that loan. It sucks. Well, I would ask you to consider this, for example. Let's take back in 2021 where home buyers didn't have 20% down and they got a loan with an FHA loan. And they were buying their home. And fortunately, because rates were low at that time, they were able to get a 3% interest rate on that FHA loan. In fact, many were able to get under 3%. But let's say it was a 3% interest rate at that time. Well, mortgage insurance was actually higher back in 2021. It was 0.85% monthly versus the 0.55 now. So it's actually less now than it was back then. But if we took their interest rate of 3% and we add that mortgage insurance on top of it from back when they got it at 0.85%, that means they have an effective interest rate, if you will, every single month of 3.85%. Well, compare that to people buying a home now getting 6.5% on an FHA loan with mortgage insurance at 0.55%. Their effective interest rate is 7.05%. But let's even put that aside and say, let's compare it to the person buying a conventional loan today who's putting 20% down. Well, interest rates today on a conventional loan are somewhere around 7%, even with no mortgage insurance. So you take the person that's buying today putting 20% down, they get an interest rate of 7% with no mortgage insurance. Whereas the person that bought that home back in 2021 has an interest rate of 3.85% based on our example that we used earlier. So while people out there can say you should never buy a home with mortgage insurance, I would ask you to consider the example that we're using here. Now, that's not always going to be the case. Home values aren't always going to shoot up and you're not always going to gain this amount of equity. But understand, over time, you're likely to be able to refinance out of that mortgage into another mortgage. Now, the person that got the 3% plus the 0.85 mortgage insurance back in the day, there's no need for them to refinance right now. Yeah, they might hate that mortgage insurance that they pay every single month, but when they compare it to the rate of today, understand they're happy about that mortgage insurance because otherwise they probably wouldn't have been able to buy a home based on where rates are at this time. So it's all about perspective. You can always say it's not a good idea to do this or it's not a good idea to do that, but you also have to provide some context as to what you're trying to accomplish. Buying a home isn't about picking the top or the bottom in the market or worrying about mortgage insurance. It's about whether or not it's the right time in your life and you're comfortable with the monthly mortgage payment. If you're not comfortable with the payment because there's mortgage insurance involved, then you shouldn't be buying a house. But if you look at the total monthly payment and you're comfortable with it and it allows you to purchase a home, then who actually cares that you're paying mortgage insurance? Because at some time in the future, you're likely going to be able to get out of that loan into a conventional loan and avoid mortgage insurance if the opportunity presents itself and if it makes sense. So while mortgage insurance isn't for everyone, understand it's the cost of doing business and allowing you to buy a home, whereas in most other cases you wouldn't be able to do that because you don't have the down payment. Now, there are other things that you need to consider when getting an FHA loan that I didn't talk about in this video, other FHA loan requirements. So if you're interested in an FHA loan, now that you understand mortgage insurance, you want to see what everything else looks like, whether or not you qualify, do me a favor and check out this video here.